Hello and welcome to Econoday Unplugged on Tuesday, the 24th of March 2020. Mark Pender is on US East Coast and I'm Jeremy Hawkins here in London. So as the efforts to contain the coronavirus become both more widespread and draconian, there's a couple of things the markets taught us last week about what happens when the chips are really down. Firstly, the dollar is still king. And secondly, as liquid as they might be, even government bonds can't always be trusted during a flight to safety. So where do we stand now? Well, at least 68 central banks have cut rates and an increasing number have turned on the quantitative easing taps, some about as far as they'll go. Collectively and crucially, as the demand for the currency took off last week, some have also provided a much needed boost to dollar liquidity through expanded swap lines. On the fiscal front, many governments have similarly set in train aggressive stimulus packages. Importantly, within this latter camp, US Congress has yet to agree on a suite of measures worth around $2 trillion. But from the way equities were performing as we record this podcast, hopes would seem to be high for some good news soon. In terms of the data, we're now starting to get some surveys of what's been happening to business activity this month, and they don't look pretty. So, Mark, let's start on your side. The Fed's been super busy over the last few days. What's the takeaway from this little lot? What's going on with the government stimulus package, and just how bad are the numbers?
The numbers aren't as bad as you might guess. Stimulus is unfolding as quickly as it can, especially on the Fed side, or entirely on the Fed side. They are pulling out all the stops, offering backstops to loan backstops to consumers as well as businesses, putting rates offering their 0.25 discount rate to virtually everyone. And unlimited quantitative easing, the works. The government is still negotiating.
On that little lot, was it a unanimous vote to get that lot through? Were there any
yes,
problems
it was.
with it?
It went right through. And the numbers have not been that devastatingly bad. We had the manufacturing PMI today. It came in at 49.2. That's not bad at all. That's almost like a normal number.
Yeah.
And but services are way down into the 30s. So it seems to be centered in the services sector. The virus hits, and you saw that also in Europe. We had the whole round of the PMIs coming through Europe. I'll let you get to that in a minute, but let me just first talk about the Richmond Fed. Now, this is a regional report. It came out of this morning as well, and it was at +2. And for this number to be at +2 is extraordinary. So they actually rose in the month. So what's going on in manufacturing?
Why?
Well,
what made it go up?
Well, delivery times are a positive in these composites. I'm not sure. Let me just check the Richmond. Hang on. I'm not sure what to let me just backtrack on that 1 second here as I check Richmond. For instance, today's PMI for market economics, they throw in, apparently they made the note that the delivery time skewed the numbers higher. So what that means is delivery times in a normal economic situation, when they lengthen, that's a sign of congestion in the supply chain and a sign of demand. But it may not be a sign of demand at all. In this case, it could be dislocations tied to shortages having nothing to do with demand, or deliveries having to do with the virus. So that is one effect. Well, let me just see. The Richmond Fed is a composite of new order shipments and employment. Now, employment did fall very sharply in all these reports, by the way. So there is your indication. And let me just go right to what we're looking at here on Thursday with jobless claims. The market news, the Econoday consensus here is about 800,000 for initial claims. Initial claims had been at 200,000 going into this, a 50-year low, at a time when the labor market was twice the size as it was 50 years ago. So this will be a shocking number. And the things that we do, this economic news, this economic data, is going to be mirroring something that's going on with the medical data. It's been spiking, of course, with these virus situations. Well, economic data is going to be spiking as well, or dipping, or it'll be challenging our database. As an aside, how to put some of these numbers in. We have to consider these things because these are going to be extraordinary numbers. It's going to hit with the jobless claim. So whether or not manufacturing is still on its feet despite all the restrictions, that's a curious possibility. But at the same time, employment does look like it's going to be tanking. So with that, let me pass it back on to you.
Okay, let me just ask you just a quick one before I go through the doom and gloom that is Europe. I noticed there was some, fairly horrendous forecasts coming out last week. Goldman Sachs were talking about the US economy shrinking by 24% in the second quarter, Morgan Stanley at over 30%, and even James Bullard from the St. Louis regional Fed talking about a potential downturn as much as 50%. 50%, yeah. Do these numbers seem plausible, or is it just sort of sticking a finger in the air and seeing what you find?
I think it's sticking a finger in the air. And in any case, even if they are plausible, they'll be reversed. If the Goldman Sachs, I believe the annual 2020 overall, they were looking at a 1% contraction, I think, something like that.
Okay.
A small contraction. So whatever movement we're going to get, I guess we'll see it in the first quarter. It looks like March is going to be taking a hit. And then the second quarter, it looks like it could be in jeopardy, of course, but then we'll probably get a third quarter snapback. And the same thing for the markets. It's, however bad these moments are, everything will very likely or hopefully will reverse. And we'll all remember this as some kind of, an extraordinary time, but hopefully a very brief time.
Well, here's hoping so, because certainly following from your side, Europe is definitely underperforming as we speak. So just to put a few numbers on it, we had our preliminary or flash purchasing managers reports for March out this morning. Now, in terms of a headline number, so the composite output index, so if you like, the PMI's proxy for GDP, for Eurozone as a whole, it fell 20 points down to 31.4. Now, that was both the steepest decline on record and also a new record low. Now, interestingly, and mirroring what you seem to be suggesting from your side, manufacturing, which has been the real problem area for the Eurozone for quite a while now, courtesy of Germany, that held up quite well. 44.8 is still pretty well in recession territory, but it was probably a little bit stronger than expected and clearly significantly better than the services index. Now, services themselves, well, it really is, it's enough to make you cry. The sub-index there weighed in at 28.4. So that was down 24.2 points from the final February reading. And again, that's a record low. It's the steepest decline we've ever seen. And just to really rub salt into the wound, from what the PMI survey found, it suggests that the rest of the Eurozone, so the smaller countries, actually performed even worse than what the headline figures were coming out the major countries. So, it's strictly speaking, it suggests that Eurozone quarterly growth is running at about -2%, so quarter on quarter. If we go back to the last time we saw PMIs anywhere around these sort of levels, so back to the 2008-2009 global financial crisis, the worst decline for Eurozone GDP then was 3.1% in the first quarter of 2009. So really, if these figures hold on to record lows, we should be looking for a decline in GDP, something steeper than that.
I have a note here, an aside. There was something out of Europe that you covered that I think it was out of Europe that cited a small sample size because of the virus. Does that ring a bell?
Yes, indeed. That refers to the consumer confidence indices the flash consumer confidence index, I should say, we had out of the Eurozone, on Monday.
That was yesterday, yeah.
Was yesterday. Yeah.
The market economics didn't, and nothing I have read in the reports that have been coming out have been citing weak sample sizes. Now, these are private. The ones we've been citing are private institutions, and they sell their data. And I don't want to I don't want to suggest that, maintaining their business can be, can come at the expense of the integrity of their numbers. But I didn't see a warning on the U.S. one. And I haven't seen a warning on any of them, actually. But the consumer confidence flash, that's produced by the European, it's an official organization.
Yeah.
It's an official organization, and they might be more careful to tell us. It was a very small fraction. It was like 15% response.
Yep, that's right. It's very low, yeah.
So we have to be careful with some of jumping to too much of the conclusions with some of this data, don't you think?
I do. I think it's perfectly safe, because at the end of the day, someone has to fill these surveys in, and it may well be the case that the people simply aren't around to fill them, to fill the surveys in the first place, because they're self-quarantining, they're at home, and whatever it may be. Mm-hmm. So I think it's certainly fair to say that the sample sizes are necessarily going to decline, and so around that there has to be an increasing amount of uncertainty. And I also think when you get to periods in economic cycles, when you get a very rapid rate of change in growth or inflation, or whatever it may be you're looking at, you tend to get a lot more what they call white statistical noise in the underlying data set in the first place, which makes it that much harder to interpret. But I guess we've got to say, whether you can actually take these PMI numbers at face value or not, just from the way they're moving at the moment, it certainly seems pretty apparent that we're going to see a large number of countries falling into some kind of recession over the course of the next few months.
Basically, these graphs are just falling off a cliff, and
they do. They look horrible. So I also quickly mention the UK as well. We had the UK PMI out this morning, just to finish off the European set. That came in, where are we, at 37.1 for the composite output index for the United Kingdom. And that, again, is an all-time record low. That undershoots the previous low we had during the global financial crisis. And again, it's a similar story again with manufacturing, which is actually 48.0, which, let's be honest, is a pretty respectable score at the moment. So the decline really down to services, which was 53.2 in February and came in at just 35.7 in the preliminary data for March. And I guess while we're on the UK, I'll just quickly round off some things going on in terms of the central bank activity here, because we have a Bank of England meeting coming up on Thursday. Does it actually matter? Well, quite possibly not, because these meetings seem to be taking place almost every other day at the moment. But as a result of recent days' activities from the old lady with Threadneedle Street, we've already seen a number of intermeeting interest rate cuts, which in a nutshell have reduced UK bank rate down to an all-time record low of just 0.1%. And we've also seen, for the first time since August 2016, an increase in the quantitative easing ceiling. So that used to be 435 billion for gilts and 10 billion for corporate bonds. So that's been increased by a total of 200 billion, up to a combined total now of 645 billion. And indeed, we've had the new Bank of England governor, Andrew Bailey, suggesting if it takes more than that, they're happy to do it. So it's kind of smacks of going down the same route as the Fed, doesn't it? Where just turn the tax
everyone's
off.
printing money as fast as they can. And does this undermine the long-term confidence in our banking system? I guess they really have no alternative. They're almost obliged to, to try to reverse the financial collapse. But it would be interesting. I'm sure that they will then want to begin to withdraw all this stimulus, and especially in the QE side, unlimited QE, and it very well may bleed into the stock market, where and just no holds barred. The Fed will print money to buy S&P 500. It hasn't come to that, but
going to be interesting, yeah. And also interesting. I think also interesting what it does with the dollar. And one thing which was blatantly apparent last week was that we saw an extremely strong dollar. As you saw this, basically everyone was offloading any asset they could find in order to buy dollar cash. So I think one of the most significant moves last week was when we saw the increase in the swap arrangements between the US Fed and a number of the big European central banks, and that being expanded to the likes of Mexico and so on and so forth. because we've simply needed an increase in supply of dollars given the outstanding demand available at the time. So again, it's going to be interesting as and when we get beyond that stage, and all of a sudden this huge demand for dollars isn't there, and we've got the increased dollar supply into the market, courtesy of all these swap lines, the unlimited quantitative easing. There could be a time then the dollar could come in for a period of perhaps real weakness.
Yeah.
What else have we got? I suppose something we haven't touched on a little bit and probably don't need to really, but I think I should mention it anyway. And that's good old Brexit, because, of course, we're supposed to be having these key post-Brexit trade negotiations between the UK and the European Union taking place at the moment, with a view, according to Prime Minister Boris Johnson over here, if nothing's been achieved or clear indications that something will be achieved by June, then he's happy to walk away without any kind of deal whatsoever. Well, I mean, to be honest, were he to even consider that in the current context of this coronavirus, I think it'd be an absolute disaster. But interestingly, we now have a position whereby both David Frost, who's head of the UK negotiating team, and Michel Barnier, who heads up the European negotiating team, are self-quarantining with the coronavirus, which means, of course, how much further can these talks actually go in the first place? So it may well be that once we get beyond June, these talks have all to all intents has come to a stall. So Brexit, or at least the Brexit or post-Brexit transition period might actually have to be delayed. I must ask, Chris, going back, looking at somebody talked about monetary policy side, fiscal stimuluses. There's things that it's difficult always trying to get hold of the precise numbers on this. But if we take a look at what I've seen from some of the promises being made by a number of European governments at the moment, we've got potential packages, fiscal packages out of Spain, more than 15% of GDP, the UK 15%. Germany, we're still waiting for some of this to be confirmed. It could be slightly more than 15%. So they really are throwing the old kitchen sink at this. So I've got to go back. I think one reason why, as we speak, the S&P 500 is up well over 6%. And it does seem a lot to do with this idea now that these governments are starting to cooperate and coordinate at least a little bit more. But crucially, when do you think, indeed, I hope it does do, this US package will go through? Because without that, I think things could well turn down south quickly again.
Well, if the market is, we're up almost in the mid single digits today in the stock market, maybe it can recover before Washington ever gets around to getting its act together. I have no idea when a resolution can be made and some kind of a package can be put together. Certainly, Jerome Powell, when he had his press conference last week when the Fed cut an emergency 100 points, was very concerned about the fiscal response coming out of Washington. And you can understand that. Now it's been more than a week and nothing has happened. So, but hopefully the markets will recover in any case from underneath it. It's hard to say. But I think with everybody else pitching in as they are across the developed economies, that maybe $2 trillion here, $2 trillion there may not make that much of a difference.
Nice idea. Although I do think personally, I think if we don't see the US do something, I've got this sense that market's going to start going down again. They've seen Europe come out now with some fairly big guns. I've seen Japan doing it, outside of Eurozone, the UK. I think they really want to see this, all the big global sides just throw what they've got at this economy to turn it around again.
When initial claims come out on Thursday morning, if they do come around the million mark, there will definitely be a push in Washington. I think that will be an economic headline that's going to, move out from the business pages into everyone's,
What do we have as a consensus on that? On the claims?
Let me see. Well, we update our consensuses. The forecasters update their own. We have it at 787.5 thousand. That would be about 3 times, not quite 3 times of what it was last week, which itself was very high, picking up an initial spike from the virus effects earlier in the month. And then, of course, what this is, and that, by the way, was already March employment report is already in the can. I mean, it was already sampled. And so all these effects later in the month are not going to be reflected in that report. But there was still a lot of layoffs happening at mid-month when that was sampled. So however bad March is, the employment report, it probably isn't going to tell the whole story. And so I think to your question about moving the logjam in Washington, I think that if that doesn't do it, nothing will.
Well, let's hope they do. Otherwise, I think it could all get very messy again. As you mentioned, in terms of course, we have seen across so many countries the coronavirus, the compliance measures trying to restrict its spread have got tighter and tighter and tighter. In the UK, for example, we had the lockdown essentially being introduced as of yesterday. So the numbers which we saw coming out, even from these PMIs in March, reflected a much looser situation where it was easier just simply to get to work and to do things. So the April numbers and the surveys, I suspect, are going to be really horrible. Okay. Anything else? Anything else?
Well, I guess we were talking about the dollar earlier, and I just wanted to note that the spike in the dollar seemed to come at the same time when the demand for U.S. Treasuries started to crack, which was kind of a surprise to everyone because that was the safe haven avenue. And then when that seemed to, dislocate, people just wanted cash. Cash is king, and not even bonds anymore or treasuries. And so that was I wanted to throw that in.
No, I think that's right. And it's very much when you get to the stage whereby U.S. Treasury is no longer regarded as being, if you like, a safe haven instrument. It really tells you about something about investor sentiment, doesn't it?
Well, if there's nothing safe with the U.S. Treasuries, there's nowhere to go. I mean,
indeed. Yeah. Okay, all right then. Let's call it a day for this week. So it may be early days, but notwithstanding what seems certain to be a string of awful numbers over the next couple of months or so, markets do seem to be at least doing a bit of bottom fishing at the moment. So let's hope so, because we do need some good news. Meantime, as always, keep an eye on Econoday's global economic calendar, updated 24 hours a day. On behalf of Mark and myself, thanks for listening, stay safe, and we'll be back next week. Bye for now.